So we're going to have a look at this Murray Movers question. I'm going to do this on the Jam board, so hopefully you can follow this at home. So Andy is the remover, Andy is the owner, let's try again, of a removal business called Murray Movers. The business owns several motor vans that are used to move furniture, strangely enough. And we've got an extract from the statement of financial position, so that should say statement of financial position of Murray Movers at the 31st of December 2012. So this is last year's figures. He had vans that cost 90,000, have been depreciated by 30,000, and had a net book value of 60,000 pounds. Okay. Additional information: during the year ended 31st of December 2013, which is the year we're dealing with, Andy purchased 3 vans in a part exchange arrangement agreed with Robson Motors. The details are as follows. So Andy purchased 3 new vans at a total cost of £45,000. So that's the cost of the new vans. Okay. But he part exchanged 3 old vans. So part exchange is where he's going to give the 3 old vans back and they'll give him an allowance against the cost of the new vans. Now the 3 old vans had originally cost £27,000 and they had a net book value of £12,000. So that means that the depreciation to date on those vans is the difference between the two. It's £15,000. Okay, and then the last bit of information we've got there is that he paid the balance owing for the new vans with a cheque for £35,000. So the cost of the new vans is £45,000. The cheque is £35,000. So that's come out of the bank account. That leaves a balance of £10,000 that he didn't pay because that's the part exchange value of the old vans. So that's going to be used for our disposal proceeds to work out whether we made a profit or loss on disposal of those old vans. And we can see quite easily here, if the net book value was £12,000, we effectively sold them for £10,000. We've made a loss on disposal of £2,000. So loss on disposal, £2,000. Okay, final bit of information is that depreciation is 33.33% per annum using the reducing balance method. And the way to deal with that one is just to take the net book value and divide it by 3. Don't try and multiply it by 33.33 because it's just too easy to make a mistake. Problems arise, people putting in 33.3, 33.3, just multiplying it by effectively 30%. So just whenever you see 33.33, find the net book value, divide by 3. Okay. Now, if we look at what's actually required of this question, we've got 3 T accounts to finish. We've got to put all the transactions in for the whole year, starting with opening balances, and then we've got to balance them off. Okay. So if we start with the motor vans at cost, this is the brought forward figure. We had 90,000 cost and 30,000 depreciation. So we need to put the 90,000 cost straight into that account, which we've got the right number of zeros. And then on the depreciation, it's on the credit side, balance brought down, £30,000. Now, if you remember, assets are a debit balance, and then any provision, so provision for depreciation, provision for doubtful debts, on the statement of financial position is always a credit balance. Okay, so one minus the other gives you the net book value. The other thing we need to deal with is the disposal. I'm going to do that in a different colour just to highlight it. So we've got to get rid of the vans that have been disposed of. They had an original cost of £27,000. So we need to take that £27,000 out of the motor vans at cost and put it into the disposal account. Now the disposal account is like the suspense account. Balance comes down to 0 because we just work out what the profit or loss on disposal is, which we already know is £2,000. We're going to prove that in our T account. So motor vans at cost, we've got 27,000. And then we also have to get rid of the associated depreciation. So the £15,000, I think it was, let's just check. Yeah, we worked out the depreciation today was £15,000. So that 15,000 is coming out of the provision for depreciation and into disposal account. So provision for depreciation, £15,000. Okay, so we've now effectively got the net book value into the disposal account, which is £12,000. We're going to match that up with the sale proceeds. So the disposal proceeds, I'll do that one in green. We need to credit this account. Now, if it was the bank, if we sold the vans for £10,000, we would debit the bank and we would credit the disposal account. But we can't do that So we're going to have to work out the double entry. Now, if we think about it, the £10,000 also forms part of the cost. So we're going to be, the double entry is going to be to debit motor vans at cost and to credit the disposal account. So we're going to credit the disposal account with £10,000 and we're going to debit motor vans at cost because this is part of the new cost. So disposal account, and this is the PX, £10,000. Okay. So now what we can do is work out the loss on disposal. Colour haven't we used yet? Let's just go for black here. So loss on disposal, which is £2,000. That's going to be income statement. We're going to debit the income statement with that £2,000 loss. And then this account now balances. Okay, so we've dealt with the disposal. Now back over to the new vans. So we've paid £10,000 here, you can see from part exchange, but they've also paid £35,000. If you look here, there's a cheque paid, £35,000 from the bank. So we're going to debit that £35,000 into the most vans at cost. So you can see now we've got the whole cost of £45,000 in the motor vehicles at cost account. Okay, and then depreciation, we're left now with £15,000. We had £30,000 at the start. We've got rid of £15,000 on the disposal, so we've just got £15,000 relating to the assets that have remained. So the next thing we need to do then is work out this year's depreciation. So what we need to do is work out the new net book value. So whatever we've got left in the cost account, which is 90 plus 45, 135 minus 27. So I reckon that's 108,000 left in the cost account, and we can balance that up. So LCD, £108,000. Means that both sides add up to 145,000. LBD, 108,000. And then in the depreciation, we had 15,000 left. So our new net book value, 108 minus 15, is 93,000. And if we divide that by 3, that gives us this year's depreciation charge, which is 31,000. Okay, so that goes off to the income statement, debit the income statement as an expense, and credit the provision for depreciation, 31,000. So that means we've got LCD, 31, 61 minus 15, 46,000 on there. So that's it complete. If we were drawing up the accounts, we have 108,000 to put in the left-hand column in the statement of financial position minus the 46,000. So our new net book value, 108 minus 46 would be 62,000. We're showing an expense on the income statement of £31,000 this year's depreciation, but also a £2,000 loss on disposal. That's how you do it. If you want to look at a neater copy of the answer, if you can't read my writing, then that's there on the PDF file. Any queries, let me know. Thanks for watching.